Well, big cap tech helped prop the markets up today. Our next guest says don't chase this mini MAGA rally, though. Let's bring in Tony Dwyer, chief market strategist at Canaccord Genuity. Tony, always great to speak with you.
Great to be here. Thanks, Mel.
You're not just talking about technology. You're saying overall, don't buy anything right now.
Well,
why not?
So I think we got to be careful about just making it a big cap tech thing. At 29.50, I'm certainly not chasing. I think what's interesting is the Fed put. If you had a strike price, Mel, it'd be right here. Because this is on April 9th, the game-changing decision that the Fed made was to announce a $2 trillion stimulus package that could buy various areas of high-yield and municipal debt. So that made it going all the way back to the low unlikely, because you do have a Fed put, and it's right at this area. So this is a perfect place to have a real bull-bear epic. The last time I was on your first day back, it was an epic battle, a tug-of-war between monetary stimulus and negative economic outcome. And what a place to rage it is right here.
So what are you saying investors should do at this point, Tony? Nothing?
So as you know, Mel, we lowered our rating in the market in January, and to get us more offensive, to kind of mirror what a lot of the other panelists have said, you need to see more than these mega cap stocks rallying. So the S&P 500 is at 28, 25 or wherever close today, right? It's all up on these mega cap names that now account for about 20% of the index. And I don't know if that's good or bad. It just is what it is. If you look underneath it, what would get me more offensive, where I'm going to say, okay, let's go in, you would want to see the U.S. Treasury market have a pretty significant uptick in yields, suggesting that it's betting on economic recovery. It's what happens each time, as we talked about last time, you're coming out of a recession, is you get a sharp steepening of the yield curve. And if you couple that with relative outperformance of the offensive sectors, I think that is where you want to start to attack. The problem is, let's say, I don't know, 5-10% ago, I said, okay, everybody all in. I would have been wrong on my sector bets, because it's been these mega cap stocks versus the underlying sustainable economic outlook groups.
Hey, so Tony, it's Dan. How are you, bud?
Good, Dan.
So talking about these MAGA stocks, okay, Microsoft, Apple, Google, and Amazon, all of them reported, really decent enough earnings. I know Amazon had some issues, but that really is a function of how much the stock had rallied. Do you think there's risk if we do take a leg lower in the broad market, that those names lead to the downside and present more of a problem than if we were to actually continue back towards 3,000, the help that they might give to the upside? Do you understand what I'm saying? Do they have the potential to snowball because of that concentration?
Well, I got to tell you, at 2,300, with the most historic oversold condition in the market's history, one of them, yeah, you got to buy for a relief rally, right? So now what I could see happening after we've been turned back at 29.50, where frankly I felt like an idiot because I didn't get it. I didn't think it'd go up that much. So back here at 2,800 with a line in the sand at the Fed announcement area, Dan, I could envision a situation where the market, the S&P 500 index itself, doesn't do a whole heck of a lot, but you start to see the rotation underneath. To Karen's point, a lot of the broad market hasn't been lifted. Financials have been a disaster. Industrials have underperformed. And even with today's strength, and today was a good day, except financials and industrials, the two offensive sectors that typically lead out of a real economically driven bear market low, underperformed. You had a nice, stabilization in the Treasury market. I want to see those groups catch a real bid, more than a 1 or 2 day bid, right, pick up their relative performance, and then I think we can get offensive. I'm looking to get offensive, not defense, but you need signs first.
Tony, great to speak with you. Thank you.
Thank you, Mel. Have a great day.
You too. Tony Dwyer, Canaccord. Karen, what do you make of the underperformance that we've seen in financials and industrials?
Well, I'm kind of surprised with the underperformance of financials mainly. I can accept that maybe this is where they should be or that they should be lower. What I can't understand is how is the broad market here with financials there? That is a big disconnect to me. Either the economy is going to be much better than the banks are telling you, or the banks are telling you the economy is going to be much weaker. Those two things I really think need to diverge. So I'm long financials. I think we're in for some big provisions coming up this quarter and maybe next quarter as well, on top of the one they just reported. but I think they're going to make it through. And so it's surprising to me that, and they are leveraged, so it's surprising to me how big this underperformance is.